And welcome to BQ Prime. You're joining us on the sidelines of the Moody ICRA's India Credit Conference. And joining us today for a special chat are Alka Anbarasu, Associate Managing Director of the Financial Institutions Group at the Moody's Investor Service, and Kartik Srinivasan, Senior Vice President and Group Head of Financial Sector Ratings at ICRA. The topic of today's chat is looking at how the Indian banking system is faring amidst global headwinds and what's the outlook for the Indian banking sector as well. Thank you both for joining us today. It's great to have you. I would really want to start with a macro question here. The biggest question in the macro lens has been deposits and credit growth, right? Deposit growth versus credit growth. Deposits have been underpacing credit growth by almost 500 basis points at this point. Is this an ongoing concern? What does it take for deposits to start outpacing credit growth? Kartik, you first.
Okay. When you look at deposit growth and credit growth in percentage terms, yes, you see a huge difference over there.
Mm-hmm.
On an incremental basis, if you see the absolute numbers, credit has outpaced the deposit growth in FY23. Absolute terms, not so much of a large margin as what one sees in percentages. We expect the trend to sort of continue into FY24 as well, whereas incremental credit growth should outshine the incremental deposit growth, but possibly with a much smaller margin.
Okay.
If you just step back, one of the biggest reasons for credit growth to outstrip the deposit growth, in addition to the credit demand, one should also see that banking sector was sitting on huge surplus liquidity, excess SLRs, which had to get deployed.
Right.
So one shouldn't get too perturbed by the number that, credit completely outshone deposit last year. But heading into this year, yes, it does become a cause for concern because if we are expecting credit to continue grow at double digits, then deposit needs to keep pace.
Right.
Else you would end up in a scenario where, deposits will continue to go up. The deposit cost will continue to go up. In any which way, not the entire rise in the overall systemic rates have been affected on the deposit cost so far. So we do expect deposit rates to go up. And that will have its own implications in terms of lending rates again going up.
Right.
So it's an important parameter at this stage, but clearly into FY24, we would still see a scenario that credit is absolute credit is higher than absolute deposit growth. So that's something to be watched out for, to support a growing economy like India and the fact that banks contribute to a lion's share of the domestic credit markets. You would need the banking sector to step up. That would mean in terms of deposit mobilization to ensure that credit is really available to all necessary and deserving sectors.
Right. Now, Alka, you look at the global picture here. Some of these trends are also replicating in other countries. In the States, for that matter, a similar pattern seems to be playing out. Are there any lessons to be learned on how to tackle this, how to not tackle this, given some of the troubles we've had in regional lenders in the US? What's your outlook on how this compares to the global scenario, and how can we bake in learnings from that?
Sure. So one thing, the weaknesses that came out from the US banking system was that the deposits was very concentrated with certain corporate depositors, and a concentrated deposit base book lends itself to risks.
Sure.
But when it comes to India or even broadly Southeast Asia, we see that the bank's deposit bases are very retail in nature. So to lead on to what Kartik was telling, maybe there's higher deposit competition, but that would mean that the banks will need to pay up a bit more.
Okay.
Their net interest margins would get perhaps come down a little bit. Our expectation is that the NIMs of Indian banks have peaked, or net interest margins have peaked. Deposit competition would mean they need to pay up more.
Sure.
Having said that, India is still a very much a deposit-led banking system. For public sector banks, deposit to loans ratios is around 75% or so.
Right.
So they do have headroom to grow, and private sector banks need to compete for deposits. But the US is a very specific situation with large concentrated depositor bases, which by itself lends to a number of weaknesses, which we don't see in this part of the world.
Okay, understood. Now, because you mentioned incremental deposits and the higher cost, but there's a divergence emerging therein. We looked at some of the data that came out from the RBI in April. Now, outstanding loans and deposits have seen the rates move up on both ends. But fresh loans and deposits, there was a dip. I think deposits themselves fresh fell by 10, 12 basis points, and loans fell by 23 basis points. What do you think explains this divergence? There's been no even mention from the RBI that they're going to be thinking about cutting rates. The stance continues to be withdrawal of accommodation. So why is this divergence happening? How does the two of you look at it?
I think it's still looking into the first 2 months of the year, so not necessarily a right time to sort of compare.
Okay.
But clearly, the rate increases and absolute mobilization, it again varies from there is a seasonality effect out here. So one possibly needs to build into that. Last year, there was not much of credit growth in Q1, if I remember right.
Mm-hmm.
So whereas this year, the number has been pretty robust.
Yeah.
We've seen expecting that the bond rates are almost peaked off. We may not see further rate hikes, or at best, one more in a couple of months' time. So to that extent, banks also needs to be competitive. So
right.
I guess depending on how each bank is placed, you are seeing some differences over there. But it's still early days, I guess, to draw any clear conclusion out at this point.
Right. So we'll have to see the trend play out over a few months at least to draw a conclusion there. Now, I want to switch over to something that's connected to the rates themselves. It's liquidity. Liquidity was somewhat deficit in May, then turned surplus, and there's been an overall skew in the liquidity scenario as well. Can you talk to me a bit about how serious this skew is? Like, how big is that slant? How oblique is that slant in terms of liquidity distribution? And how long is it expected to continue? Because on the one hand, you have the RBI moving to withdraw liquidity, but banks not showing up to give that liquidity. So does that skew feed into it? How long does the skew also take to get resolved? How you see it?
So we need to look at it in a different perspective. If you just step back,
sure.
Last year liquidity was very high in the system. A large part of that got utilized in terms of incremental credit for the sector, and the liquidity sort of ran into deficit for quite a period of time during FY23.
Yeah.
Currently, we're seeing some surplus back. We are in a positive territory as far as surplus liquidity is concerned. While we have our estimates of credit growth in that 11 to 12% vicinity for the current financial year, I guess most of the banks expect to have much higher numbers than that. So possibly just holding up on the liquidity front. Plus, the recent decision to withdraw the 2,000 rupee notes from the market. So that's also suddenly, infused the system with liquidity.
Yeah.
So I guess, and we are into the, the advanced tax period. So it'll be a combination of all these things, which can lead to a little bit intermittent variations if, we were to look at data at a particular point in time. It really makes sense to look at these data on a longer time horizon and time trend to draw any meaningful conclusion. As I said in the earlier comment, we are unlikely to go back to the significantly higher levels of liquidity that we witnessed in the early parts of FY24.
Sure.
So to that extent, it is going to be far more subdued this year. And to that extent, you could see measures from RBI trying to either suck out liquidity or put in liquidity, as they also tend to reignite their focus on attaining the 4% inflation number. That seems to be the target which they've been articulating over the last two policies as well.
Right. And just on the skew a little, and I want to bring in you, Dr. here as well, because even globally, we've seen bigger banks get even bigger, whereas smaller banks have struggled. Here also, I'm not saying only the big banks are sitting with excess liquidity. Typically, PSUs also are holding a lot of liquidity. But just, is it important to resolve this skew to begin with from how you see things? And how do we move to resolve that skew if it's necessary?
It's important. See, the thing is, the entire sector is getting polarized. Now, we've seen in periods of stress, good or strong getting stronger, and the weak or small getting, going the other side. So that's something that we are seeing out here as well. Let's say 2 years back, you had the mid-size or the smaller banks offering higher deposit rates.
Sure.
So they were, in a period, they were able to garner more deposits than the system. But today, with rise in interest rates and even the larger bank offering higher rates, so to that extent, if somebody is a bit more risk averse for whatever reasons, somebody said, let me just park the money with the quote unquote the larger or the stronger bank as compared to somebody else, because that differential is not much. Why do I need to take a risk for a mere 25-50 basis points, as a retail depositor or a retail investor? So that's sort of playing out. Things will become interesting maybe from next calendar year, that's when we believe that the RBI may start cutting rates, and maybe that's a time where we will possibly see the stronger banks cutting rates faster than the others,
and then reversal of the trend happening there. How do you see this, Alka, on a global level? have these sort of trends played out in the same way? Are there any variations? How can we sort of imbibe those?
No, indeed, we see flight to quality during times of stress.
Sure.
So clearly, whether it was COVID or even what's happening in the US right now, there is flight to quality. So the deposits are moving to larger banks.
Right.
Clearly, that's one safety element involved in it. But the other element that you've been talking about is to some extent maybe interest rates on deposits.
Yeah.
And what we've seen across perhaps globe or much more in Southeast Asia, the interest rates started rising quite rapidly last year on back of US monetary tightening.
Sure.
And banks started offering much higher interest rates on deposits, not seen for a very long time.
Right.
And deposits flew to the banking system. But now banks, even across the region, have slowed rate increases or even cutting interest rates. So some of the larger banks are offering lower interest rates. And clearly, customers are now starting to see other avenues for deploying their monies as well, which is where perhaps some of the money is moving out of the banking system. And similarly here as well, into more market instruments as well.
Okay.
So banks are not just competing with each other, but they're also competing with the mutual funds and other parts.
So has there been a
the
significant migration of bank deposits to money market mutual funds, you would say?
There has been a migration. I mean, I wouldn't have proper data points to articulate how much has gone out, but clearly we are seeing that deposits have peaked to some extent. And if anything, the low-cost current and savings account deposits are turning into term deposits, and from term deposits, some into money market funds as well. But clearly, there is this movement of funds taking place, which is where perhaps your question around liquidity availability, it is tightening across the region. And we expect some of this will get passed on to bank borrowers as well.
Okay. Understood. Now, I want to move from deposits to the other side of the equation, which is credit. At least in India, we've seen a very significant rebound in unsecured personal credit. That's been the flavor of the season. You talk to any banker, unsecured personal credit is the way to go. It's a good product. Everyone's comfortable with it so far. What do you make of it? What has led to this sharp increase? And secondly, has there been any loosening of credit underwriting standards on this side that you may have observed, be it anecdotal or be it structural?
I think what we need to understand out here is the credit landscape has changed significantly over the last few years with digitalization.
Okay.
So digital underwriting, availability of data, which has really helped the lenders, be it bank, be it NBFCs, to sort of do whatever data validation they want, cherry pick their customers, and then run after them.
Okay.
So to that extent, as compared to, let's say, a decade or two earlier, the dynamics have changed. So one can actually take a very conscious, calculated credit call today, basis data, which was not really available in the past.
Okay.
Number one. Number two, everybody's again started chasing growth and profitability. And this is a sector which gives you opportunity to scale up.
Yeah.
And also at much higher yields, which in turn, if done well, improves the overall return on assets or return on equity. So that's been the clear logic. Clearly, a large part of it has been driven by the digital play which is involved. The concern from our side as credit analysts is the growth too fast?
Yeah.
Is credit underwriting standards being diluted?
Yeah.
Nothing to suggest as such at this point in time, but we are quite watchful and mindful that any lending decision that you do today, you'll probably see the pluses or minuses, the good or bad 2 years or 3 years down the line. So maybe whatever lending you've done today, FY25 or FY26 is when you would know was these decisions good or not. So,
but are there any? So I know loan books take time to cycle over, FY25, 26, as you said. But are there any warning signals to watch along the way as well?
At this point in time, actually, there are no. Even if you look at whatever data one gets from banks or NBFCs or credit information bureaus, the DPD numbers, be it 0+, 30+, 60+, whatever data is available, we're all seeing an improvement trend. So one reason could be we just come out of COVID when numbers were really bad. And to that extent, we continue on an improving trend, and at least in the near term, we do expect that to continue.
Okay.
And more importantly, just to add on, one also needs to factor in that the bank and the NBFC balance sheets are much stronger, much more resilient today than they were 3 years back. So we can't rule out any credit event or a rise in slippages in the future. But the fact that the balance sheets are strong, their operating profits are pretty decent, which should definitely help them absorb some of the shocks and still, stay well above water.
Okay. And is this a trend that we've seen, the unsecured credit piece? Is this a trend that we've seen beyond just India and Southeast Asia as well? Has it grown in Southeast Asia? Has it grown in other neighboring countries? What's the outlook? What has credit growth been driven by in other parts of the world?
Sure. So I think one market that has seen very strong growth, perhaps not coming from unsecured segment, is China.
Okay.
Where property market loans have grown, and loans to property market developers as well have grown quite rapidly. And that sector is undergoing its own challenges. In fact, within Asia Pacific, we have a negative outlook for China's banking system because of the property market woes. We are seeing similar property market issues in Vietnam also, which is a very strong growing emerging market. But again, property market has seen very strong exuberance, and we are now seeing some of the challenges come down to banks' balance sheet. To your broader question on unsecured or retail loans, household leverage in many parts of Asia Pacific is very high. In many markets, Thailand, Malaysia is around 80% of GDP. Korea is much higher. In India, household leverage is much lower. So to that extent, there is room for credit to grow. The Credit Bureau has significantly revolutionized the data availability for underwriters to perhaps originate loans as well. And we think for the banks, they have a diversified loan book. So whether it's corporate, retail, SME, that diversification in itself provides them some comfort against taking, say, maybe more risk in one particular segment. But where in India I would be more concerned is perhaps monoline players or monoline NBFCs, which are growing quite aggressively in retail and unsecured segments. And in particular, there is some opacity also developing in the system via the co-lending arrangements or arrangements with Fintechs and other players, where perhaps the data availability or availability of early warning signals may lag the actual outcomes, which is where we would be more concerned. But broadly, perhaps, low credit penetration in India gives room for this segment to grow over the next few years as well.
I want to double click on the CIBIL under the credit scores in a second, but I also want to ask you about the housing segment in India. Now, there's some divergence emerging wherein affordable housing seems to have slowed down, whereas luxury housing and like the more premium housing continues to be very upbeat on both sales and credit growth. Is this a trend we can expect to see continue over FY23, or what changes this? I mean, I know rate cuts is one thing that could happen later down the line, but other than that, what's your outlook on the housing credit market, and will the sort of divergence between the luxury and the affordable continue?
I think again, one will have to look at a slightly longer horizon. I mean, after the IL&FS crisis, last couple of years, we did see marked slowdown on the high ticket home loan sales and home purchases. Whereas it was only the affordable which was really selling or moving. And we've also seen even large HFCs and banks, having a separate team or a special focus on the affordable segment. So now with stabilization in economy, looking at growth numbers, so we are definitely seeing some pickup or a revival in the real estate, and consequently pick up on the home loan sales and purchases as well. So volume wise, yes, a large ticket transaction gets far higher volumes than affordable. Having said that, from a medium term perspective, I think affordable is here to stay. Again, coming back to Alka's point, the under penetration levels, mortgage to GDP is still over 10%, 11%. It's far lower as compared to other developed economies. And there is a lot of action, a lot of scope to scale up beyond the tier 1 cities. So in that context, affordable segment is something that will continue to grow, and in all likelihood will be much faster than the overall industry growth if we were to look at a AUM basis from the HFCs or the banking sector point of view.
Point taken. Now, coming back to the credit scores here. Now, I had a very interesting anecdotal experience on this, wherein a friend of mine, or like a rather colleague, who's never taken on any credit, they sort of downloaded a credit score app for the first time, and they checked, and it was 700 something credit score. Now, that may qualify them for a lot of unsecured personal credit right at the score guideline, right? If you're just using the score as a cutoff point. For banks and lenders who've entered into the unsecured segment more aggressively, more recently, do you feel they have augmented their credit underwriting and understanding beyond the credit scores, or the credit scores are the only way to go right now, which can, as in the case of someone who may have never taken credit, it could go either way, right? They could either be very good with managing their money, or just that inexperience could cause some issues as well. How do you see it?
So that basically depends on which is the lender and what's the strategy they are using.
Yeah.
So what we have seen is, one, you don't lend only to people who have never taken credit. It's only a part of the portfolio. It's a selective credit call. What profile of borrowers are you willing to take that risk? Somebody who's never availed of any credit from anybody else, who is a new to credit, if I were to use the market lingo over there. So what proportion of your portfolio would you take a new to credit customer, and what should his or her demographics and other metrics be? Number one. Number two, in some of these areas, what we also see anecdotally is when banks and larger institutions enter into such segments, they do try to piggyback either by way of co-lending or a fintech arrangement where somebody else does the initial underwriting. You put in your own filters that you want to cherry pick out of that particular list as well, and then take baby steps towards it. So that's an approach that's been largely used by many of the lenders who want to test a new market, new segment, new geography before you scale up and have more ambitious plans to enter that segment.
Okay. So now closing out the retail segment, because you mentioned fintechs, the 5% FLDG allowance that came last Thursday.
Yeah.
Now, do you see this as a significant fillip to fintech lending in India, or will this be more of a gradual process? Because FLDGs were crucial to doing fintech lending, then they sort of disappeared for a while, and now 5% has been allowed again.
See, it all depends on how well the guidelines are operationalized. Let's look at it this way. Before RBI put a stop, FLDGs were a way of life, and you were having FLDGs being given by these fintechs and platforms, and nobody really knew who was actually bearing the losses. I mean, there's always a confusion or a gray area around that.
Right.
But now it's clear that as a fintech player, a non-NBFC also, you can give an FLDG up to 5%. So there is, we've reached a middle path somewhere. So to that extent, that market should again grow up. But clearly, it is going to be, how comfortable would the regulator be in terms of how these guidelines are actually operationalized? I think one of the biggest fears which the regulator had was, is the entire risk being borne by these platforms and not by the NBFC? Are they being borne by unregulated entities? So again, so that's something which the RBI has tried to address by way of this regulation. Probably take a couple of quarters to see how well are the regulations being put into place.
Okay, understood. Now I want to move from retail to the more capex side of things. We've seen some sort of pickup in wholesale credit and infrastructure credit recently. Would you say this points, like I know you said one should always look at things in a longer term horizon, but does this in any way point to an infrastructure cycle coming up? Are banks ready with their risk appetite for that sort of cycle to start? What's your outlook?
See, banks have been getting aggressive on the infra space over the last year or so, but it's again largely been on the renewable side, or road side, where it's operational projects. See, as a country on the corporate side, we are seeing capacity utilizations go up to 70-75%. There have been a huge number of announcements of private capex, but they're yet to hit the ground. So the thing is, what we see now as wholesale credit picking up is a bit more of a refi which is happening, not so much of a new credit or a new project which is being financed. So the articulation of what you're saying will have banks change their risk appetite, will possibly come to know, and in a couple of years when these projects really hit the ground, you get financial closure and you actually start drawing down from the system.
Okay. And actually I want to come to here on you are here on this as well. Given the global environment as well, there's some thinking that if rates stay elevated in the West, we might see Indian companies move back to India to do some of their refinancing on their external commercial borrowings as well. How much of a inflow of demand do you think that will be? Is it sizable enough to get banks excited about it?
Yes and no. So one is, I don't think we have seen significant refinancing by Indian corporates in the international market this year because of the way rates are going, and particularly Indian corporates are required to fully hedge their foreign currency exposure. So the all-in cost, including hedging cost, turns out to be much higher than domestic borrowings. Also, RBI has certain restrictions on the spread that Indian corporates can offer on foreign currency borrowings as well, or external commercial borrowings. So that limits the kind of corporates that can go out to borrow as well. Clearly, some of those refinancing can take place domestically as well. But that's really credit moving from maybe one pocket to another. But the big flip that can come to credit demand is via the capex cycle, which you just talked to Kartik about. But clearly, we are seeing some uptick in the capex cycle, whether it's infrastructure or even government spending, which can crowd in more private sector investments as well, which is what will give perhaps more sustained growth to India's banking system as well. Because for India's GDP to grow at perhaps 6, 7, or even 8%, we think credit needs to grow at least at 1.5 or more than that percentage points of GDP. And that kind of demand we are not yet seeing. While it's coming from retail, it's a corporate which is lagging, where capex cycle really needs to pick up.
Okay, and is there something banks can do to encourage corporates to crowd in investment? I know this is typically a demand and supply driven equation, but to create a more hospitable environment from the two of you, are there any recommendations that you would say, okay, these changes could make both domestic and foreign corporates a little more inclined towards doing capex in India?
I see the government has been making a lot of announcements.
Yeah.
The state governments have announced a lot of projects as well. The thing is, how soon are these actually implemented?
Right.
I mean, announcements are one thing, but the actual implementation. I mean, one of the key areas, let's say the power sector reforms.
Sure.
The state SEBs are still not in the pink of health.
Yeah.
So, an improvement on their health could automatically lead to a spur in investments and demand all over the credit landscape. So I guess a lot has to happen in terms of implementation of various ideas and strategies that's being floated at multiple levels. That would be key.
Okay.
And we're coming back, to the point to fuel that demand. Corporates will always be opportunistics.
Yeah.
They'll be raising funds from wherever they get it at the best terms, including at the finest of rates. Today, overseas funding doesn't come cheap.
Yeah.
So you've had a scenario where most of these corporates have fallen back on the domestic banking system for credit growth.
Yeah.
And deposit has been lagging credit, so you need a way to actually shore up on the deposits.
Right, you need that fuel to keep.
You need that fuel. For good, the Indian banking sector, like most of the other APAC regions, are fueled more by deposits, unlike the Western banks, where you have a lot of capital markets in their funding structure.
Right.
So it brings with it its own set of stability to the system, but then that also needs to grow to keep pace with the hopefully an increasing demand coming from the corporate side.
Okay, now we started with the macro question. Let's close out with the macro question here. Now, the RBI's GDP estimate for FY24 is around 6.5%. The current year was 7.2% full year growth. Inflation forecast is 5.1%. So going to move up slightly while growth moderates. What does this do to both consumer confidence and lending confidence? These change in macroeconomic variables. And how does that feed into credit growth and deposit growth from how you see this?
So if you look at it point to point, yes, we're going to be seeing a dip in growth numbers, a rise in inflation, but we're still pretty okay in a relative perspective.
Okay.
So to that extent, we don't see too much of slackening coming in terms of demand. Yes, the fear is that a large part of the rate hike which the RBI did last year, the effect of that could play into this year.
Right.
And that's the reason why the growth estimates are any case lower than the 7.2, which happened for FY23. Yeah. Our own internal in-house estimates for FY24 is more at 6%, not at 6.5%, as suggested by the central bank. Yes, so there are both. We are a bit guarded in case the El Nino plays out, then maybe the numbers could come down.
Yeah.
Or in case the government spending actually increases in the first half, we may actually see a higher growth as well. And clearly, from interest rates point of view, unlikely to see a sharp decline in the near future, because the MPC is pretty committed to getting the inflation numbers closer to its anchor rate of 4.
Right.
Even as per their own estimates, we're not going to hit anywhere close to 4 for FY24. So to that extent, the probability of interest rate cuts this year looks a bit difficult.
Okay.
There's going to be a balanced play net at a peer level. We still provide more opportunities on both the growth as well as on the credit as well as deposit side. So
Right.
we expect that to play out more so, given that the financial sector is definitely in a much better health as compared to a few years back.
Okay, and Alka, finally, there are expectations of a global recession. There have been expectations of a global recession since the year started. There's a seesaw that says recession will happen, will not happen. Let's assume for a second that we do have a mild recession. How much of that feeds into growth prospects for India and consequently into credit quality from India? How you see this?
So right now, India is in a sweet spot. In fact,
Okay.
India is the fastest growing major economy
Yeah.
globally. And to that extent, I think to your earlier question, consumer confidence or even
Yeah.
business confidence is coming back, and
Okay.
it's at good levels right now. But to your question around slowing global demand, and clearly India is quite skewed towards global demand as
Yeah.
well. A slowing global demand will have repercussions on India as well. But having said that, India is still very much a domestic story, where there are very strong reasons for growth to continue, a clean banking system, corporates which have deleveraged, and there is a very strong capex momentum as well coming back. So to that extent, we think a lot of areas are in favor of India right now. India is not immune to global conditions for sure, but that would perhaps play in via the exchange rate channel or via country's current account deficit channel, which would have some impact on the government spending momentum. But on-ground momentum still remains quite strong in India.
Okay, so you expect that to be buoyant even on the export side of things, because a lot of our MSMEs are export-oriented, so we could see some of that impacting them, would you say?
There would be an adverse impact over there. If you look at the data, I guess the merchandise exports, we have been seeing some degrowth. So definitely there is some pressure over there. Services exports are still holding up in the positive territory, though lower than the past data. But that's something which is a point of concern. One is closely watching that. But at a macro kind of a level, I guess FY24 we should be in a position to sail through. Let's say if really you see a sharp recession in the global economy, then you could have some further revision downwards for the Indian markets as well.
Right. So your headline question for the conference is like, will Indian banks thrive amidst global headwinds? If you had to give me a phrase to answer that, each of you, what would it be? Alka, you first.
Yeah, we think Indian banks' credit conditions are improving. So improving credit conditions would be my phrase.
Okay.
Because they are at a stage where they are in a position to fund credit growth in the system.
Okay. Kartik, what's your phrase of choice here?
Ride the domestic tailwinds.
Ride the domestic tailwinds. All right, I think that's a great point to close us out. Thank you to you both for joining us for this conversation, and thank you to everyone for watching. For all the news and updates, you can catch them on BQ Prime. Thank you.